Now, you can remember the tax is not a tax on production. The tax is a tax on consumption. It's not a tax, even though we are using, businesses to collect. It's not a tax on production. So ideally, you can say, let everybody finish the value addition. Let everybody finish the value addition, and then we collect the tax at the end. And that will be 490 at 17.5%. So because you consider the others as not being selling to consumers, you just wait till the end where they are in touch with the consumer and then you sell. But there's a weakness in focusing on the retail. We know it as the informal sector and others in Ghana. So what do? You can also decide to collect on the value added. You remember 1,000, 17.5 is 175. The person has 800, so his tax is only on the value added 140, and then it goes on. And you get the same 490 at the same price, 32, as if you were collecting it at a single point. This is a text. Any policy intervention that changes these two amounts of money introduces a distortion. And it can be positive or negative, like social intervention. If you want to exempt education, health materials, and the rest, you exempt it from the output VAT, and therefore the price goes down. The revenue also. But if you block, we'll come to it. If you intervene with this, you can end up increasing, the price, right? And the revenue or the tax burden. Okay. So we said the weakness already. The weakness is in the fact that, when you do this, at the end, you are dealing with the informal sector, and all that. Now, so what is the VAT mechanism? The VAT mechanism charges all of these people to impose a tax on the cumulative value that is added. So you have 175, and then, sorry, we move on. So you have 175 on the 1,000. The cumulative value added is 1,800. Okay? But remember, in the 1,800, there is 1,000 on which the tax was collected already. So you give the manufacturer credit. That gives the name invoice credit. So he must show an invoice that he paid. So he doesn't double. You don't double the tax, right? Then on the 2,400, there's 1,000 on which the tax was collected already. There's a 600 on which the tax was collected already. And so you give a credit for the next stage. You give a credit for 175, so you give a credit for 315, right? So that they end up paying the tax on just the value added, as we saw previously. And we achieve the same results. So the strength of this, what we say is that if you don't have an invoice, you cannot claim the credit, right? And therefore, we say the VAT is self-policing, because the one buying is anxious, to get the credit. So they help GRA in making sure that they get, because when GRA comes, GRA will want to see before you take your credit. They want to see that, you have an invoice to show that you pay the tax. So they help GRA, right? So when that credit, let's take note, and that's the point with Get Fund and with all, when that credit that is given, right, is refused, denied, or disrupted because there's no invoice, the businessman is not a philanthropist. What do? If they don't have an invoice, or somebody or the officials block the credit, what do? They add it to cost. And so the base will now include the input, the tax on the input which they couldn't claim, a credit. And so this is the difficulty we are having with most of the measures that are being implemented now, right? So when you block the VAT, the VAT which the businessman paid, which used to be Get Fund or NHIL, or when you introduce a new tax, CST, right, and you block input tax credit, or when you introduce even a 3%, which is supposed to be net, yes, but you block that credit, all that credit that is denied will be added to the cost. Will be added to the cost, and therefore it would, what we say, cascade. That's the way we call it.